We'd like to welcome each and every one of you once again. We just took 2 or 3 minutes to allow more people join in the call with us this morning. Without much ado, I'd like to quickly run through what the program would look like today. So just as you were promptly and adequately informed, you're joining this webinar, and the theme for the webinar is going to be about the Financial Act 2020 that was signed into law recently, and the imports and the impacts on payroll, and with much focus on the HumanManager application. So once again, thank you for joining us. We'll be having an overview session where one of our senior consultants will be taking us through for the next 25-30 minutes. And then we'll have a Q&A session, question and answers. If you recall that you were requested to send in questions ahead of time so that we can maximize our time this morning. So we'll be taking some of your questions. And should you have questions during the presentation or at any time during this webinar, please feel free to use the chat room. We will not be using any audio or verbal feedback for this session. Thank you so much. And then finally, at the end of the program, we'll be having a feedback session, and a quick poll will be taken. I will be very grateful if you could just take your time to quickly fill. Trust me, it's not going to be a long one. And thank you so very much for joining us. So without much ado, let's dive right into the business of the day. So please warmly welcome with me, Mr. Tope Olugbeja-Bell. He's going to be taking the overview session for the next 20 or 30 minutes on the Finance Act and its impact or import on the payroll. Thank you so much. Mr. Tope, please enable your video. Yes, we can see you. You're welcome this morning. So you have the floor. We call him T-Bell, by the way. So T-Bell, you have the floor. Thank you.
Thank you so much, Debbie. This is a beautiful day. Good morning, everyone, our beloved customers. This is that day we've been waiting for to know a bit more about tax. My name is Tope Olugbeja-Bell. I'm a consultant with SystemSpecs. Very quickly, we want to run through the Finance Act 2020 and its impact on payroll tax, to be specific. And we'll try as much as possible to make it as engaging as possible and as fun in between. So welcome again as we run through the session very quickly. We have about 25 minutes to do this, and we should be done shortly. Okay, thank you so much. I want to believe you can see my screen and we can run through this together. Okay, Finance Act 2020 and the impact on payroll tax. Basically, we're trying to run through the background when the law was signed, what it's about, and most importantly, the scope of the FA 2020 for reference purposes, sticky notes, things to know, and then the impact on payroll and our promise to our beloved customers, we will always be there for you. And I believe we have tried, but we are more fired up than ever to keep doing what we do. And you inspire us to do more, hence why we're here. President Muhammad Buhari, our beloved president, on the 31st of December 2020, signed into law the Finance Act 2020. It's actually a follow-up to the Finance Act 2019. So hence we have two of them now. The 2020 is an amendment to the 2019 Finance Act. And it amends particularly the Personal Income Tax Act, PITA, 2011, and a host of other tax laws in the country. So it's not just one law. It affects a lot of laws, particularly the Company Income Tax Act also affected CAMA, lots of them. So what we're trying to do here is to highlight the fact that it's not just a unilateral change, but the fact that it also affects other kinds of laws, and we'll try to explain that as you go on. Federal taxes or taxes in Nigeria today can manage by three arms of government, has its unique body set up to manage taxes. We have the Federal Inland Revenue Service managing for the federal government. We have the State Board of Internal Revenue Service doing that for state governments. And they manage everything from collections, the rules guiding it, and appropriation, how to get those funds from customers and how to make the best use of it. Even remittance, they have discussions. So everything surrounding tax lies within this body. Moving forward. Okay. Please let me know. All right. So we're saying the Act, the FA 2020 Act, actually covers more than just the changes to Personal Income Tax Act, like I mentioned earlier. It also covers stuff like CETA, CGT, stamp duties, Fiscal Responsibility Act, the Public Procurement Act, so many affected. By my last count, there were over 15 different taxes that have been impacted by the FA 2020. So it would be nice for you to get your hands on the Gazette for the law. And when we say Gazette, it simply means that it's been documented, it's been finalized, and we now have an official Gazette out there available to the public to go through and understand how the law works. And that also specifies when the law takes effect from. This is the official Gazette, for instance, for the Personal Income Tax Act, 2011. It first was amended in 2007, and then you had the second amendment in 2011 where we added the new tax table and also the consolidated relief allowance, which interestingly is the crux of the matter in this particular change that just happened. So this is the Finance Act 2020, the very latest of our tax laws. And it's, like I said, has excellent changes to not just the PITA, but other tax acts, just a few here and there. To be frank, the Company Income Tax Act seems to be the one that got the most heat in terms of changes that has been effective, but we'll get to know them better as we go. The highlight for this session is the payroll impact, hence why we're narrowing it down as we go on. Possible exemption of tax-free items paid out of pocket. So I'm saying these are sticky notes, areas in the Current Act that may not have been fully fleshed out, but it's good you know ahead of time as you go into it. Tax-free items paid out of pocket, voluntary pension, life assurance premium, interest on mortgage, should they not be tax-free? Why are they being deducted from the CRA today? So those are questions still out there for the tax authorities to help resolve and coordinate. Dependents and child relief are still applicable, as neither both laws, the PITA 2011 or the FA 2020, took it out expressly. It's like they're silent about it, so it kind of allows it to continue. So those are areas we're saying are still gray as of today, and more work may be required to make that happen. The Finance Act and its impact on payroll can be there are like 7 of them, but the critical ones are 5. And those 5 have been highlighted in this presentation. You have gross income for CRA, life assurance premium, minimum wage exemption from tax, loss of office compensation, tax deductible contributions to pension. We're going to move on quickly so we don't take too much time. Now, tax deductible, I try to explain, apart from the Pension Act, your Pension Reform Act recognizes pension and voluntary pensions. We're saying if you have any other contribution scheme, some companies do have them, that works like a pension scheme. If you want it to be tax deductible, you need to register it under the Pension Reform Act. So that means it needs to be recognized, and then it means the funds will likely go to them as well. That way, they can now be registered and it will become a tax relief on your payroll. Otherwise, if it's not recognized under the Pension Reform Act, it is not tax-free. Call it any name you like it. If it's not the pension, or voluntary pension, then it is not, or gratuities, you cannot pass it as a tax-free item on payroll. That's what this law has specifically demanded we do. Loss of office compensation, we're saying, should you be asked to leave or you voluntarily retired and there is some money allotted for that purpose. If it is less than 10 million, it is tax-free. You're not paying a dime for it on the company gains tax. But if it's more than 10 million, you pay 10%, or the company pays 10% on the excess, on the extra, as company gains tax to the government twice a year, I think in June and December of the year, based on the new law. Minimum tax exemption from minimum wage exemption from tax. Now, minimum wage exemption from tax allows it such that for every low earner, those who earn less than 30,000 naira a year, they are not fully exempted from tax. They're not to pay a dime. But it doesn't remove the minimum tax, meaning that if you earn above 30,000, you're still going to pay the minimum tax. And that's what this law has strategy. But it's good in the sense that those who earn lower no longer have to pay, tax on that small amount. We know how tough the economy has been in recent times. Great. Life assurance premium reintroduced. We're saying life assurance premium is now back. It was taken out in FA, Finance Act 2019, and now brought back fully into the tax rebate or tax-free items list for payroll in the FA 2020, meaning you can, as long as it's an annual premium paid in previous year assessment or a life assurance act that has deferred annuity, it can be used on payroll as a tax relief item. Fantastic. Yes, so we are now at the meat of the matter. We have gross income for CRA computation redefined. And this, like I tried to say, is the major change in what we know as tax today. Between 2020 and 2021, this is the major change. What has changed? The definition of gross income has been modified. We're saying income from all sources, less non-taxable income, when no further tax can be applied. That is what now, and then that income, notice the specific mention of tax exempt lists on paragraph 2 of the 6th schedule. This is talking to the PITA, Personal Income Tax Act. So let's quickly take a look at that schedule. This is the PITA rule. This was taken directly from the Gazette. Notice the 6 schedules list specifically tax exempt items. Schedule 2, National Housing Fund, National Health Insurance Scheme, Life Assurance Premium, National Pension Scheme, and gratuities. And this is what that law speaks to, this new rule saying that gross income for CRA computation has been redefined. So let's try and run through an example to make it clear to everyone how this really works. And very simply, this is a typical payroll. It could be one person's salary. I actually love this, this figure looks nice. In case there are HR people out there, this is a good figure to give your staff. You can start, with me. Not a bad idea, but this is an annual amount. So this is not the monthly, just in case some of us were, really digging, but it's fine. This is good. So let's move on. We have the gross pay, annual tax bill. Notice the end income pre-FA 2020 and then FA 2020. Remember, FA means Finance Act. Before the Finance Act, after the Finance Act. Okay, so basic salary, 8 million. Housing for up to wardrobe allowance. This is everything. Remember, the law says all sources, less non-taxable income to arrive at the gross income for CRA. CRA meaning Consolidated Relief Allowance. Now, we're trying to understand using this example. So we're saying gross pay, normal gross pay, or total income, or end income. Notice the different description of it is equal to basic salary or base pay plus total allowances. All your allowances put together plus your base pay gives you your gross pay or your total income for the month or your end income for the month. Now, on an annualized basis, this is what we have on the screen. The total income is 19.250 million. So nothing has changed. The law does not affect your income up to this point. What you earned before is what you're still earning. Nothing has changed. So you're not increasing your salary by any means necessary. What has changed is how the gross income is treated. Notice total income on the first page. On the next page, we're now looking for gross income, which is another definition for CRA gross, or Consolidated Relief Allowance gross. This was introduced in Peter Act 2011 amendment, where you now have a CRA, Consolidated Relief Allowance, that put together. The definition is quite simple for CRA. We're saying gross income for CRA is total income minus the NHF, pension, gratuity. All these are those tax-free elements mentioned in the 6th schedule. Remember the 6th schedule. The 6th schedule is here. This is from the law directly. We're saying those elements, when you subtract them from what you have, you end up with these items here. So minus, these are the tax-free elements: voluntary pension, life assurance, interest on mortgage, and you get a new item called gross income, or CRA gross. This is the example. Notice total income less pre-FA is 0, all true. Post-FA, you now have values at this point, and that gives you a gross income. So you are no longer using 19.25 million to compute CRA, consider relief allowance. You are now using 15.6 million. You are less tax-free elements. Moving on, you now have the formula for CRA. 20% of gross income, not total income, gross income, plus 200,000 or 1% of the annual gross. Now, notice this is stop pointing to gross income and not your total income. Total relief is the CRA, plus NHF, plus pension, plus gratuity, plus voluntary pension, plus life assurance premium and insurance. So now we are bringing them back. This is the real law. This is how it has always been in Peter. The only change is the fact that before we get to compute total reliefs, we have to deduct them to arrive at a new CRA gross, which is what we now have. Our considered relief allowance gross, or gross income, is now 15.6 million, less the relief items. Now, having this example, we now have the total reliefs, normal total reliefs computed, 7.7 million pre-FA, now 6,970 post-FA. The difference highlighted in red is the variable CRA, which is your 20% of gross income, not total income. Remember, gross income, total income. Gross income is the same thing as CRA gross, less the tax-free items, okay? And what does this mean? The real impact is simple. We're saying that because your CRA has reduced, your total relief has reduced, the tax charged will be slightly higher because of that reduction in CRA gross. And that is what, so invariably, everybody's tax, apart from those who earn 30,000 naira below, is likely to jump up a little bit. And that is what this example tries to show. So we have total income less total reliefs. So we're still using total income, and no longer, the only thing you use the gross income for is to compute CRA, period. Once you have your CRA, that is added back. Notice fixed CRA, 200,000 or 1% of gross. Variable CRA, 380, this is the 20% of gross income. So the only part where this new rule applies to is the variable CRA computation, but it's significant enough. Everything else is the same. NHF, 2.5% of basic, pension, gratuity, all is fine up to that point. So by the time you do that, pass that through the tax table. Now, we may have another session for tax table, understanding how the tax table works in general. But when you pass the net tax table, or the chargeable income, which is your total income minus total relief, what is left is what you tax. Now, what is left is now 11.5 million. You know, it was 19.250 initially, and now 12.280. Notice that post-FA is now higher than pre-FA. So that is really the significant change in tax based on this new law. Payee is now 2.564 million, 2.7. So it's higher because of that change. Divide this by 12, you get the monthly value or the figure for tax in there. And then we'll put this into a final table where you have the payee tax table. This is the normal, we're now back to payroll now. From payroll deductions down to payee tax table, pension, NHF, we just took the figures as they are. We now have our tax figure computed. Notice that when we get the net pay value, the net pay is how much I take home at the end of the month. This is a good net pay, by the way, a very good net pay. I hope HR is watching. Yeah, so we have the 14.686 or 14.510. 14.510 becomes the new value based on the new law. So there's a difference of 175,200. By the time you divide that by 12, it looks very minute. The truth is, it's a slight increase in tax, depending on where you are on the tax bracket. But this will affect everybody who earns more than 30,000 naira in a month in the Federal Republic of Nigeria. And this principally explains how CRA impacts. So there are 5 of them, and this is the last of them, which is for me the most important in terms of its impact on tax. And notice the tax table I mentioned earlier. This is Peter 2011 as amended, where you have the graduated tax, or what we call pay as you earn. Pay as you earn. And it's still, the law has not changed. This has not changed. This is just me showing you how we arrived at tax on the system. So moving on, our promise to our beloved customers remains ever focused, ever strong. And I'm sure we proved it a bit in February, March when we implemented the new Tax Act. We identify with you and will reliably confirm, or we can reliably confirm that our products are efficient, they're tax efficient and compliant to the laws of the Federal Republic of Nigeria. Beyond that, we are saying that as long as you're trusting us with your payroll and with this process, you will always be a step ahead in terms of tax laws. And in coming up with this presentation, we had to rely heavily on regulated tax authorities and professional bodies like Deloitte, KPMG, Anderson, PwC. We had to rely heavily on their documents they had put up in the public space, and also with experience of what we have. And so we believe strongly that together with your cooperation or partnership, we will do much, much better going forward. Thank you so much for your time. It's been a pleasure to be here. Debbie, over to you.
Thank you, Tibel. Thank you so much, Tibel. I hope, I want to trust that our participants have found is quite insightful. And thank you so much for managing the time so well, so we can take as many questions as possible during the QA session. Okay, so let's dive right into the QA session. On our panel today, we have 3 of our very valued members of the team. All put together, they have over 3 decades of experience delivering payroll solutions, building payroll solutions, and then supporting. And then one of us is also a tax certified specialist. And so please make welcome with me, in no particular order, Mr. Akin Omojola. He's a products manager and one of our panelists this morning. Thank you. I hope we can cite him. Give us a slight wave, Mr. Akin.
Good morning, everyone.
Good morning. Thank you. Next on our panel, we have a tax specialist in the house. She's a certified tax specialist, and she is Mrs. Comfort. We call her Mother, our great mother in the house. Please make welcome with me this morning, Mrs. Comfort Adebi. Can you put on your video and let's the house see you briefly?
Yes, my video is on. Good
All
morning,
right.
everyone.
Good morning. Nice to see you this morning, Mother. All right. And finally, on our panel this morning, we have a very able Sibyl. He just made the presentation. Thank you so much. So nice to see you again, Sibyl. Mother, please, if you don't mind, please, you could take down your video as we take the questions one after the other. All right, so we have some questions that were sent in ahead of time. And just as I mentioned earlier, if you have questions that probably came up during the course of the presentation, please feel free to use the chat room and drop in questions. We'll do our very utmost best to make sure we attend to as much as we can. And please, just in case we don't get to your question, I hope not, please know that you can always reach our consultants and also send us an email at support@humanmanager.net. Thank you so much. Okay, so first question for this morning will be going to Mr. Akiomodula. And it says, what are the major differences between the old computation and this new act? I hope you got the question. Please put on your video. All right, thank you.
All right, thank you very much. Like Tokwe earlier showed us, there are 5 main areas where the Finance Act has affected payroll of companies and their employees. Number 1 is that, generally speaking, for people who earn above 30,000, they'll be paying slightly higher tax because their effective tax relief has reduced. The relief on tax has slightly reduced. That's the first thing. Number 2 is that for people who earn below 30,000, they are now finally exempt from tax. I know for many of us in organizations, we have very few people or no people at all who are in the minimum wage category. But in the general economy, there's a lot of people still in that minimum wage category, and now they don't pay any tax at all. Before, they used to pay at least 1%. Now they won't be paying any tax at all. Number 3 is that for those of us who stopped our life assurances last year because of the Finance Act 2019, we can bring it back in now, provided it's a life assurance type recognized by the previous pension and tax laws. Number four is that if you have a capital gains tax, capital gains. Now, capital gains has to do with anything about maybe incentive retirement or incentivized resignations, early retirement, redundancies, and you pay bulk values to staff to lay off, all those kind of things. The government has been magnanimous in that before now, you had to pay capital gains tax on the value. But right now, the law only stipulates a 10% tax rate, similar to before, capital gains tax rate, on anything above 10 million. So it is, if you earn 10 million and below, you as a retirement benefit or something, you won't pay any capital gains tax on it. But if you earn more than 10 million, the excess more than 10 million, you would have to pay a capital gains tax on it. So these are 4 areas where the tax laws, where the new Financial Act affects you and your staff. Thank you very much.
All right, thank you so much, Mr. Akiomodula. I hope the person who asked the question has a robust answer. I would like to crave the indulgence of our panelists to please keep the responses as brief as possible so we can take as many questions as we can accommodate. All right, the next question goes to Mother. That's Mrs. Comfort Adebi. How do we protect employees from over-taxation, given the present economic challenges? How do we protect employees from over-taxation, given the present economic challenges? Please put on your camera and then quickly attend to the question.
What you can do is to encourage your employee to key into non-mandatory tax relief, like life assurance. They can go into engage in mortgage payments if they can afford it. And if they cannot afford it, it could be part of what your organization can help in supporting your employee to do so that they can get the life assurance interest as a relief. You can enroll your employee for NHF. You can let them pay part of their. You can introduce reimbursable, authentic reimbursable, that is the receipt will be presentable from a recognized place. So those are the things that you can encourage the employee to do to increase the volume of their relief. And the Act is even recognizing that for the employees who have actually were running life assurance plan in the year 2020, it could be used to reduce the effects of the tax in 2021. So that is another very good area that you can encourage your employee. They can bring the receipt of the life assurance that they have paid in the course of the year 2020, which will be now used because that is this 2021 to reduce their tax burden. And they can, for those of them that have not really registered going into insurance, life assurance, they can be encouraged to do it. But they have to do it in a recognized place, and the plan has to be acceptable into the law, by the law. Thank you.
Thank you so much, ma'am. Thank you very much. Next question, please. I'll be going to Mr. Akin. Are reimbursable items tax-free? Are reimbursable items tax-free?
All right, thank you very much for that question. Yes, reimbursable items are tax-free. However, one, there must be.
Okay, it appears we're having a bit of an audio challenge with Mr. Akin. T-Bell, if you don't mind, could you please take response to that question, if you don't mind? Thank you.
All right. Yes, reimbursable items are really not taxable. They are more like, it depends. They are not payroll items. A reimbursable item is income and not earned on payroll, income, money you have spent on behalf of your office or company or organization while in the course of doing your official work. Maybe you travel to Abakaliki and you spend your money, out-of-pocket expenses on hotel bills, on travel, on tours, on food, and you come back and make expense claims. Interestingly, we have an expense claims module that could help organizations manage your expenses as you make these expenses and you make cash advance and retirement, all done electronically on the system. Software today has that functionality. Now, once these claims are made, getting your money back is what comes as reimbursables on payroll. So it's like a refund. So it's non-taxable by default. So it's not really a tax relief. It's more you're getting money, you're being paid back money you had already expended. The only issue is that for reimbursable items to be properly recorded, there has to be receipts to show that these expenses were actually made. So you cannot just come and say, I bought 250,000 lunch. No, you need to show receipts that you actually had a lot of heads to feed on that day. Thank you.
Thank you so much for your answer. I will try to keep this as, take it as fast as we can. We have loads and loads of questions dropping in. So let me just take one of the questions in the chat room. Okay. How quickly will your products be tax compliant in terms of future changes by the government? Do we have Mr. Akin back? Mr. Akin, please, can you help us with an answer to that question? How quickly can our products be tax compliant in terms of future tax changes by the government? Okay. It appears we still have a bit of a challenge.
Can I step in?
Please go ahead. Thank you.
Yes, I believe we've proven to our clients that immediately the tax is gazetted and it's available to us, we make the change necessary. We did this in February. for the FA 2020 Tax Act. Once it was released kind of late January after payroll, but we were able to make sure to sensitize our customers early and also get them to give consent so that we could implement the changes on all applications across the deployments. And today, they are fine. Even though we do have a few customers that have said they're not ready to be compliant yet, we can't force them, but the solution is compliant in terms of the tax act. So once the new tax act is developed or gazetted, we're more than a step ahead to ensure the solutions we produce or provide for our customers are tax compliant at all times. Thank you.
All right, thank you very much, sir. I have an interesting question here, and I'll be putting it across to Mother. Mrs. Comfort Adebi says, considering the fact that life assurance premium and mortgage interests are paid out of pocket by the employee, they are not part of his or her compensation. Why should they be deducted from the gross income CRA computation? The person asking this question says, it doesn't seem right. I'll just quickly run over the question once again, just for in case some people lost me along the line. Considering the fact that life assurance premium and mortgage interest are paid out of pocket by the employee, they are not part of his or her compensation. Why should they be deducted from the gross income CRA computation? It doesn't sound right. Please go ahead and answer the question, ma'am. Thank you.
Okay. The way to look at it is this. Life assurance is paid out of pocket, right? On few occasions, some people have some arrangements with between the insurance company and their HR to deduct life assurance right from their payroll. But majorly, most of the time, people pay life assurance out of pocket. Life assurance to personal income tax is like every other expenses that you made out of your pocket, but it is recognized by law. And the reason why they are removing it now, I think it is now that the government wake up to do the right thing, is just to prevent the double taxation, double relief. And that is why they are removing it from the CRA gross computation. Because if they leave it there, if you have to enjoy it, remember that when they are now considering your free pay, your tax relief in total, we will now add the life assurance back. We have NHF back. We will add NHF back. I'm just saying that so that maybe because the same thing applies. And if you have some reimbursable that is paid out of pocket, we add it back. However, if we leave that to be computed in the to form the part of CRA gross, then we are overstating or we are double counting the relief. That is, I think the people that are behind this are just realizing some of us have enjoyed that and now they respond. I hope I've been able to answer the question. Thank you.
Thank you, ma'am. I hope the person who answered asked the question is satisfied. We have just about 10 minutes to quickly round up. Next question, going to Mr. Akin. Why did it take SystemSpecs so long to come up with this? How do we reconcile the loss period with tax authorities? When is the new law going to take effect on HumanManager? I hope you got the question right, sir.
Okay, so let me respond to the question very quick. Number one, we have implemented this since February 2021. The president signed this into the law on the 31st of December 2020. We naturally want all stakeholders to react to the law before taking a position. So we waited a full month, consulting with stakeholders, looking out at other stakeholders in the tax industry to interpret and evaluate the impact of that law. Also to allow many of our customers to adjust to the new realities. I believe we sent a communication out to our customers to sort of give them an heads up that we're going to implement this on our system to stay compliant. So that's why it took us to February to actually roll it out for our customers. However, many customers still have the discretion to determine how they want to, when they want to apply it, especially for those who run HumanManager within their own environments. Now, in the future, we intend to even be faster because compliance is critical for us, and it's our expectation that our customers will also react faster. We waited this long to have this session because we realized that many of our customers did not understand the full implication of the law. So these are some of the reasons why we're having this session now. But on our system, the thing has been effected since February of this year.
Okay, thank you so much for that clarification. And then moving on to the next question quickly. If your employer pays for employees' life assurance, can an employee claim the premium as a relief? I'll take that question quick again. I think this should go to Mother. If your employer pays for employees' life assurance, can an employee claim the premium as a relief? Thank you. Please take the question.
Okay. If the essence of relief is to reduce the burden on the payer of the tax. But if it is the employer that is paying your life assurance, it has become part of your emolument and part of your benefit and part of what you are enjoying. You are not bearing the, or the employee is not bearing the cost directly. So there are two ways to it. Some employer can be so kind that, well, as a further incentive, because if they pay the life assurance, they should be able to claim that from their own ledger, from their own account. You know, they are going to pay company law, company tax. So that will be used in that, but they might choose not to use it as an organization and allow the employee who is the direct beneficiary to still enjoy that. That means once they've allowed the employee to claim that, they will not be able to claim it again. So it's a game between the company who is paying, a discussion between the company who is paying and the HR or the employee, to whether they want to release it to be used by the employee or they want to claim the benefit as a company. Thank you.
Thank you so much for your response, madam. Moving on to the next question. I have good day presenter, so I'm assuming this question is targeted at our presenter for the day, Tibel. Why was the dependent relatives allowance omitted from your computation? Was it expunged from the act? So this is a two-part question. That's the first part to it. Two, the second part to it says, by implication, there is no incentive or benefit for either voluntary pension or life insurance policy. I think I'll just quickly run through that two-part question again for Mr. Tope Tibel. Good day, presenter. It says, why was the dependent relatives allowance omitted from your computation? Was it expunged from the act? By implication, there is no incentive or benefit for either voluntary pension or life insurance policy. Mr. Onyem Solomon.
All right.
One asking this question.
Thank you so much, Mr. Solomon. Really appreciate your question. No, it's not expunged from the act. The dependent and child relief are still there, like I mentioned in the sticky notes, but it's less likely emphasized. It's not emphasized as much as it used to be when it was the main thing you added to the personal relief. So now that we have CRA, like we said, it's still open since it hasn't been expressly said don't add it. So, but for this generic example, we decided not to add it, but it could have been added. It will make very little impact really because those sums are really meager. To your second question, sorry, David, can you help me with the second question?
Yeah, the second part of the question says, by implication, there is no incentive or benefit for either the voluntary pension or life insurance policy, based on the first part of the question. Yeah.
Thank you. Now, on the contrary, I actually disagree with you on that. There's a lot of incentive for you to continue doing your life insurance premium and your voluntary pension. Why? You're still enjoying 100%, as in 100% of that relief on your tax rebate, on your tax computation. What has been done is that the gross used to compute CRA has been reduced, yes, but you still get to enjoy 100%. So let's assume you had a payroll, the same example I showed, without voluntary pension, without life assurance premium, that individual will pay higher tax because there's no cushion, nothing to fall back on. But for those who currently have a life assurance premium or interest on mortgage, or they have voluntary pension in place, they actually still enjoy 100% of that relief on their tax. So it's still good to have them. Thank you.
All right. Thank you so much for the response. Our time is fast running out. You wonder where all the time goes. But we have just 2 questions left. I think we can quickly take those. So first of the 2 questions says, kindly provide further clarity on how health insurance scheme can be used as a tax relief. Kindly provide further clarity on how health insurance scheme can be used as a tax relief. I'd like to direct that question to Mr. Akinomojola. Thank you.
All right, thank you very much. If you look at the slide Tokwe shared during his presentation, he expressly gave us a screenshot of the Gazette of the Peter Law 2011, the Gazette of that law. And in that law, it was stated that one of the things that you could use as tax relief alongside NHF pension was NHIS. So if you ever need to defend yourself, it's just a matter of referring to that tax Gazette and showing it to your tax consultant or your tax accountant or even the auditor. I think most of them know that it is. Now, if you don't have a corporate health insurance that you provide, if your staff can provide evidence of registration on the national health insurance by themselves, you can use that as the evidence. You need to keep a copy of that document for the staff and use that as the evidence to promote that on the system. For us, our system accommodates the ability to attach that item to individuals or to your entire pay structure. Thank you.
Thank you very much, Mr. Akim. And last but not the least, we have, is overtime allowance taxable? Overtime allowance, is it a taxable item? So I'll direct this question to our presenter for the day, Mr. Tokwe. Thank you.
Yes, overtime is taxable 100%. Unfortunately, I wish it wasn't, but sorry, it is 100% taxable.
Okay, we have 1 or 2 questions coming in. We really do crave your indulgence to extend this session for just about 5 minutes, if you do not mind. I'm sure we are all getting valuable responses and information that we'll find useful. Okay, so I think I'll take this final question. But with the deduction of the voluntary contribution from your gross before arriving at your CRF, this would reduce what would be your 20% CRF. I'm sure this question is directed to, okay, it's a follow-up question I can see from Mr. Solomon. So this is directed to our presenter for the day. I think Mr. Solomon is following your numbers closely. So Mr. Tokwe, this is for you to respond to. It says, but with the deduction of the voluntary contribution from your gross before arriving at your CRF, this would reduce what would be your 20% CRF. I want to trust that you got the question, Mr. Tokwe.
Yes, I did. Yes, you're right. Absolutely right, Mr. Solomon. It reduces your CRA, 20% of gross earning, the variable CRA, and that is the major impact of the FA20 Act on amendment on Peter. But it doesn't take away the fact that those reliefs are still enjoyed 100% after the CRA gross is computed. Thank you.
Okay, thank you so much. And then on the final note for this session, a number of us have asked and requested if your presentation, the presentation that was made this morning, can be shared to the House. I'm sure this is something we'll be able to communicate to everyone. And after this session, we'll be putting together a summary of the presentation and sending to you by email. So I want to really appreciate you for this time. And before you quickly leave us, we have one more thing to do. Thank you so much, my able, my able assistant at the background. So there's an assessment that's come up right before you. We'd like you to quickly, please take 2-3 minutes to just answer the questions. Thank you so much. It shouldn't take much of our time. I think we can do this in another 3 to 5 minutes. We have just 7 questions. And as we feel, I'll just quickly run through them. Once you're done, you just click on submit and we'll have your answers right with you. What is your rating of the webinar host? What is your rating of the webinar presenter? How would you rate the webinar presentation content? Number 4, what is your rating of the webinar question and answer? Number 5, what would you want this webinar engagement? Would you want this webinar engagement to continue from time to time? Would you like for us to engage more this way? And then 6, how often would you want this engagement to hold? We want it to be a part of the decision-making process. We value your feedback and your suggestions. And last but not least on the assessment, what is your overall rating of this engagement? Thank you so much. I'm sure majority of us, if not all of us, would have, I'm seeing the numbers moving. I can see the poll moving. Thank you so much. We appreciate your response. Thank you, thank you, thank you. And while we're completing that, I'll just take some of our closing remarks for the day. So once again, we really want to appreciate you for taking valuable time out of your busy schedule. We do not take this time for granted at all. We want to believe that it's been a productive period. Please feel free, like I earlier mentioned, to get in touch with us. You have more questions, you have other areas you require clarification. Our consultants are waiting and they're always excited to help you. You can reach out to consultants attached to your organizations. You can also send us an email on support@humanmanager.net. Support@humanmanager.net. I believe our polls should be done by now. Thank you, thank you, thank you so much. So we're rounding up the session right about now. And if you'd like to, you could please exit the platform at your convenience once you're done with the assessment. So this is a big shout out to our participants who have come from various organizations, industries all around the country. Thank you, thank you, thank you so much. We look forward to providing further service and holding more sessions like this with you. Thank you, thank you, thank you.